Ladies and gentlemen, good day and welcome to Mahanagar Gas Q2 FY25 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Probal Sen from ICICI Securities Limited. Thank you, and over to you, sir.
Thank you, Palak. Welcome everyone to the post Q2 FY25 earnings call of Mahanagar Gas Ltd. With us, we have members of the senior management, including Mr. Ashu Singhal, Managing Director, Mr. Sanjay Shende, Deputy Managing Director, Mr. Rajesh Patel, the Chief Financial Officer, and Mr. Rajesh Wagle, Senior Vice President of the Marketing Division. Before starting the call, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature, and we do believe that expectations contained in the statements are reasonable. However, these statements do involve a number of risks and uncertainties that may lead to different results. So, we urge you to consider that quarterly numbers are not a reflection of long-term trends or indication of full-year results. With that said, I will now hand over the call to the management for their opening remarks, post which we will have a Q&A session. Over to you, sir.
Yeah, very good afternoon. I'm Ashu Singhal. I'm joined by my colleagues here. A very good afternoon to all the investors and posing confidence on the Mahanagar Gas Ltd. and all the analysts who are on this earning call of MGL for the second quarter of the financial year 24-25. At the outset, I would like to thank you all for attending this call and wish you a very happy Diwali and a auspicious occasion for all of us and a prosperous new year in advance. MGL continues to create CGD infrastructure across its business segments in the licensed area. During the quarter, 58,845 domestic households were connected, and thus we have established connectivity for nearly 2.58 million households. We have laid 70.59 kilometers of steel and PE pipelines, taking the total length to over 7,124 kilometers. We also added 5 CNG stations during this quarter, and with this we have 352 stations as on 30th September 24. We also have added 99 industrial and commercial customers during this quarter, and therefore as on 30th September we have 4,920 industrial and commercial customers. In respect of our RA Raigad GA, up to September, we have connected 83,364 domestic households and 49 CNG stations, which are currently under operation. During the quarter, we have laid 10 kilometers of pipeline in Raigad, thereby taking the total length to 433 kilometers. With respect to UEPL, that is Unison Enviro Private Limited, a wholly owned subsidiary, the company has added 7 CNG stations during this quarter and a total of 64 CNG stations as on 30th September. During the quarter, 1890 domestic households were connected, and the cumulative household connections are 29,229 for UEPL, and they have 59 industrial and commercial customers as on 30th September. We also commissioned first LNG station in Aurangabad in month of October under the joint venture company, which is Mahanagar LNG Private Limited. This LNG station was set up within 6 months from the availability of land, one of the fastest commissioning of LNG stations. Coming to MGL's operations during the quarter, overall average gas sale volume was for the Q2 of the current year compared to the corresponding Q2 in the previous year has increased to 4.042 MMSCMD from 3.575, which is an increase of 13.07%. Q2 volume consists of CNG volume of 2.886, PNG of domestic PNG of 0.528 and 0.628 MMSCMD was supplied to industrial and commercial segment. Compared to Q1 this year, overall sales volume for Q2 has increased by 4.75%. Current quarter EBITDA is rupees 399 crores compared to previous quarter EBITDA of rupees 418 crores. Net PAT is rupees 283 crores for this quarter as compared to 285 crores in the previous quarter. Coming to UEPL, during the quarter, company achieved an overall average sales volume of 0.164 as against 0.168 MMSCMD in the last quarter. The current quarter volume consists of CNG volume of around 0.152 and PNG volume of 0.012. Therefore, MGL as a consolidated entity has achieved total sales volume of the quarter of 4.206 MMSCMD. On October 7th this year, MGL has entered an indicative and non-binding term sheet with International Battery Company USA for setting up an EV battery cell manufacturing facility in India under proposed joint venture company, which is called International Battery Company Private Limited. The plant initial capacity is 1 gigawatt hour, which will be developed in two phases of 500 megawatt each. The proposed equity investment by MGL in the range of 385 crore in this joint venture, with the equity stake of approximately 40%. The board has also approved the scheme of merger of Unison Enviro Private Limited with MGL. The scheme is subject to necessary statutory and regulatory approvals from NCLT and other regulatory authorities under applicable laws. MGL has been awarded 4 Golden Star under National Safety Councils of India safety rating for our occupational safety, health and environmental management system at CGS Mahape. With this, I conclude and would like to open the floor for the question. Thank you very much for your patience.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Murarka from Axis Capital. Please go ahead, sir.
Yeah, hi. Thanks for the opportunity. So my first question is on this the APM gas allocation reduction. So I understand that there's a change in classification of the APM gas by ONGC, which has led to this. My thought was that if all the new production is going to come from, it's going to come from the wells which will be priced higher, does it mean that the $6.50 gas that comes to you will keep falling now every quarter from even the current levels? So could you just help understand that?
I mean, the point is well taken that at one point the APM reduction has happened, but this is not a very regular phenomenon, because maybe there are certain decisions and the government has taken a call for the one-time reduction. After this, it will be gradual on year-on-year basis. It is not expected to be sudden cut on the APM.
No, but the new production that comes in will be from the newer wells which do not qualify under the $6.50 gas. So even if you get the domestic gas, it will all be higher priced at, let's say, $9 or so. Is that understanding correct?
Yeah, that is correct. Because the APM allocation, APM production is in two categories. One is the old wells and the second is new wells, for which ONGC and other producers are putting more money into it. So as per Kirit Parikh recommendations and as per the guidelines approved by the cabinet, the new wells will qualify for a different price regime, which is around 12% of the 12% of the Indian oil basket. So whatever new gas will be coming will be priced higher. But again, CGD is getting priority there also, like in HPHT. The whole gas which is available from new well will be allocated on CGD in priority before giving to other companies.
Sure, you'll get the volume, but basically it will be at a higher price then.
That's right. And HPHT volumes are also expected as and when they come on, all the older contracts are expiring. That gas will come on the bidding, and there again CGD will get the first priority.
Right, but I'm sure you must be taking this up with the ministry, but if let's say the gas price is going to go up consistently, and I mean the blended gas cost because of the newer wells issue, how do you kind of stay competitive versus the liquid fuels and also kind of push LNG, push gas into newer markets?
So, as I think MD said, whatever cut is there, of that almost 50% will be available to CGD on priority basis at 12% of the Indian crude basket. Okay, that could be, as you said, maybe around $9 or so. So it will increase the weighted average cost to a certain extent, definitely, right now. So we will be, attempting how do we optimize our cost by, initially we may have to blend spot, but we will slowly optimize by tying up the term contract, and we'll work upon how do we, devise our long-term gas sourcing strategy, so that, one more point I would like to bring is, yes, we were always prepared as a company or as a city gas industry also, people are prepared that this is likely to go down, but yes, it has happened a little faster. So all of us are working on strategy in the long term, how do we, have our sourcing contract strategy in place, which gives you an edge, and our dependence reduces day by day on the APM, which was a scenario already known, but yes, the speed has, with this cut, slightly gone up.
Just to supplement that, since you asked how would we be placed against alternate fuel, currently our CNG prices are the lowest in the country. So by a corollary, the headroom which we have is more comfortable compared to what other people have. So that also helps us a bit.
Plus, one more point I would like to add on to what CFO and Rajesh Wagle have mentioned, is that our gas, whatever we are getting, new well gas, is linked to oil linked prices. And the alternate fuel for industrial and commercial is primarily linked to oil linked prices. Plus CNG is competitive to petrol and diesel, which again is oil linked prices. So obviously there will be costlier procurement in terms of APM allocations, but still, as far as we are concerned, our one-to-one competition with alternate fuels will be more in tandem.
So, and this last question, is there any baseline margin that you look to protect that will not go below this?
Not be given a number that this is what we target, but general guidance which we have given is rupees 10 to 12 EBITDA per SCM, which we have still maintained. If you have seen our Q2, still we are at around 11 rupees per SCM. So that margin, that range we expect to continue for some more time, and let us see how the prices vary of LNG and APM gas and Indian crude basket and petrol and diesel. Plus we will keep an eye on the volume growth, which we think, as you might have seen in the results, the volume growth has picked up quite substantially in this particular quarter. And last quarter on quarter, we had more than 2%. This year, this quarter on quarter, we have more than 4%. So the whole last year-on-year growth was 5.5%, whereas in 1/2 yearly we have seen a growth of 7%. So this has come out because we have launched CNG schemes also. Our prices are very competitive as compared to petrol and diesel. So it is a mix of all these factors that we will decide on the margins. It is not that we have a set number in our mind.
Good. Thanks. That's all from my side.
Thank you.
Thank you, sir. The next question is from the line of Sabri Hazarika from MK Global. Please go ahead, sir.
Yeah, good afternoon, sir. So a few questions. Firstly, I think the OPEX per SCM was also higher during this quarter. So any particular reason, or it is the normal run rate?
The operating expenses marginally higher, you are right, around 25 paise per SCM. Okay. There were one or two one-off items during the quarter. In case of employee cost, there was an actual valuation hit, that has slightly increased in the quarter, linked to, revision in the gratuity policy of the company, linked to, income tax limit being increased from 20 to 25 lakhs. So that has given some increase. Also in this quarter, there was an ex gratia payment which has been accounted. So these two items are, costing maybe around 7-8 crores in a quarter, which is a one-off item. Apart from that, there was some cost booked on account of repair maintenance. We have taken up some aggressive repair maintenance and improvements in the network for monitoring the consumption geography wise within a GA, DRS wise also, so that we have a better control. And some small amounts have been spent, at least in this quarter, towards marketing or promoting the CNG vehicles. Okay. So maybe our expenses on promotion of CNG will continue for some time to come. But these are some of the one-time initiatives to ensure the long-term volumes by capturing more and more vehicles and making these systems more robust. Okay.
Right, sir. Secondly, regarding this volume, so it has been like 2-3 quarters now that your volume growth is very strong. And you have always maintained that 6% is the guidance. So is there a relook into the guidance, and also the fact that what exactly is driving so much of growth? And both CNG as well as industrial, I think both of them are growing very rapidly. In CNG, you have said the marketing schemes and all, but can there be any other sector in industrial? What exactly is happening?
Industrial, in the last couple of quarters, we have managed to add on some large volume customers. In fact, one of our largest volume customers has ramped up to his full volume requirement in September. That happened in some phases. So these customers whom we have reached out and managed to connect in GA2 and GA3 especially have contributed to this. And this is the outcome of almost a 1.5-2 year, initiative which we had been pursuing by convincing these industries to switch from liquid fuel to gas by giving them a guaranteed 10% discount to the FO or whatever fuel they're burning. That has paid off, started paying off, and that is giving a double-digit increase in industrial volume.
So guidance is the same, or is it now further up from 5-6%?
Sorry, could you repeat your question, please?
No, your guidance will remain same as 5-6%, or can you increase it?
So we are, if you, I just mentioned earlier also, 5.5% was the overall volume growth year on year. This first half we have clocked 7%. So our guidance was around 7-8% by the year end. Now, first half we have around 7% growth on the volumes as of 31st March this year and 30th September this year. So by year end, we expect another 2-3% to grow. So we will be touching around double-digit number for the year end. And for next year, we will see how it rolls out. But the momentum is there, as mentioned earlier, that we have launched certain CNG Mahotsav very recently once again. And we are promoting PNG also very aggressively in domestic and industrial and commercial. In fact, industrial and commercial has grown by more than 10% last year, and this year again we expect it to be in double digit. So these initiatives and competitive cost have made the fuel more viable for all the segments.
Okay. And a couple of bookkeeping questions. What was EUPL revenue and EBITDA for the quarter? Sorry, revenue and PAT.
Yeah, one
For
minute.
H1 it is around 173 crore, and EBITDA was in the range of around 11 rupees also.
No, PAT, I mean PAT.
PAT is 6 crore for the quarter.
Okay. And revenue, you said 1,730 crore, 173 crore for H1, right?
That was half year.
And APM allocation for the quarter was how much percentage?
UEPL?
No, over for MGL segment.
So 71% was the overall CNG, and PNG we were getting 105% as per the government policy. So CNG has come down in this last reallocation to around 57-58%.
You mentioned 69% in Q1, so that has become 71% in Q2, but now it has gone down to 57-58%. Is that right?
The overall APM, that is domestic plus CNG, both put together was around 71%. Okay.
Right.
And
Okay,
now, it has
now
gone down on an overall basis around 16-17%. But if you consider only on CNG, after allocating full requirement for domestic towards out of APM, then on only CNG, if you consider, it is 20% down.
20% from the earlier allocation. So overall 13-14% down from earlier in absolute number.
Got it, sir. Thank you so much. I'll be in the queue. Yeah.
Thank you.
Thank you, sir. The next question is from the line of Nitin Tiwari from Phillip Capital. Please go ahead, sir.
Hi, sir. Good evening. Thanks for the opportunity. So my questions are partially answered, but just staying on that topic of deallocation of APM gas and how the strategy would evolve post that deallocation, because as you also pointed out, this deallocation has just accelerated the change which was already happening, right? So essentially, it all boils down to how we are going to price the products, I mean CNG particularly, in order to maintain our growth and margin. So again, I mean, we want to question you on do we maintain our are we going to maintain our guidance of 5 to 6% growth that we were looking at earlier, and along with a margin of 10 to 12 rupees, because I mean, the way we look at it, given that this deallocation, a broad sense is that a 5 to 6 rupee revision in CNG price might be required for you to maintain the margin. And when that happens, I mean, the gap certainly closes with a petrol price and a lot more with the diesel price. So would that not impact conversion of vehicles and growth of volumes? And I mean, this is certainly a near-term problem. A corollary to that is that essentially this change was any which was happening. So what's your strategy, 4 or 5 years down the line, when your APM allocation would be really low and you would largely be dependent on imported gas or expensive gas? So how do you see the scenario panning out then? If you could throw some light on that, sir.
Your question is primarily divided into two parts. The first part is, which we have already discussed, that the volumes in this year has already touched 7% growth from 31st March of 2024. So in 6 months, 7% growth is seen, which we were thinking about whole year 8% guidance was there. So in the remaining 6 months, we can see another growth of 3-4%. So we will be touching around more than 10% of growth for this particular year. Now coming to the long-term perspective, yes, you are right. The APM will be definitely not available to the extent which it is available right now. And we have sufficient legroom available, one, and we have our operational efficiencies coming in place. We have our assets which are slightly depreciated. We have volumes in our place. We are doing procurement efficiencies. We are going to different sources. We keep on examining what are the alternate availables like Brent linked, Henry Hub linked, HPHT, New Well gas, APM gas which is not connected to the grid can get connected, and that can get allocated to CGD. So overall, if we see, we have been selling CNG and PNG at the cheapest in the country, and we have some margins are also in the reasonable range of 8 to 12 rupees or 13 rupees. Now, having said that, we don't think that we will not be able to manage these cuts in APM in future. And as and when things roll out, it also depends how crude moves, how gas moves, what is the delta between the two, and how the petrol and diesel are priced, and how CNG. Because once a CNG vehicle is in, it is there to stay for 15 years. We don't expect that CNG vehicle will be sold out or whatever happens. Because, see, petrol, again, there are projections about oil getting costlier and gas getting cheaper, because gas, several terminals are coming across the globe. Mostly in Qatar is adding capacity. Australia has already added capacity. US has already come on board. So we have a scenario where gas costs will be competitive as compared to oil prices. So we feel that we will be able to manage, but it's very difficult that 4 years down the line, what will be the margins. So we can't predict anything on that. But nevertheless, we are prepared to have position in different scenarios which unfold over a period of time.
Fair enough, sir. That's very helpful what you pointed out. We were just looking at it from the perspective that, once the gap really closes with petrol, I mean, when your break-even time period basically increases substantially, and it starts inching closer to maybe a productive life of the vehicle. So, I mean, correct me if I'm wrong, a CNG vehicle is about 1.25 lakh rupees costlier than a petrol vehicle, right? And essentially the break-even right now would be at about 4 or 5 years roughly. So, given the gap between CNG and petrol prices, I mean, once this gap closes and your break-even reaches 8-9 years or more than that, then certainly, I mean, it doesn't make any sense to own a CNG vehicle. So, again, a second part to that question, would you also then start looking incrementally more at LNG as a sales product rather than focusing purely on CNG? And what is happening, sir, on the tax front? I mean, we did hear some rumors or media bites during July about the excise cut or possibly inclusion of natural gas in GST. So, any incremental development on that front, if you can throw some light on that aspect as well.
CNG volumes, let me respond first on why we see that we will sustain in the coming years also. There are three primary sources from where the CNG volumes are coming. Number one is private cars factory-fitted OE, which a lot of OEs now are pushing and encouraging, and the percentage of CNG cars sold out of the total cars sold in the country is continuously increasing. Today, for a new car buyer, CNG is offering almost a 50% fuel cost compared to petrol at today's price. Tomorrow, even if that goes down to 40% or 30%, there still remains a substantial incentive for the customer. Use CNG. This is about the private car segment. Second, volume is from three-wheeler also. It's little an eyes-closed decision for them. The savings are very attractive. The last segment where we are getting traction, especially since the last few months, is the commercial goods vehicles, and especially the intermediate and heavy commercial goods vehicle segment. And we are, even though the competition there is diesel, we are targeting those segments by giving very attractive discounts through fuel cards, etc. This decision is in favor of the transporter or the buyer. So we still believe that there is enough of a long growth runway to maintain this 6% or 7% or whatever, even in the head of a few pricing challenges, which are again, these are commodities. There will be times when they'll move one way, there will be times when they move the other way. But the volume growth sustaining there without too much of a problem.
Coming to your two questions which you mentioned right now, that the one that the CNG vehicle cost versus petrol vehicle, there is. I think there is a lot of noise coming from background. Yeah. So there are different costs involved in different segments. If we talk about passenger vehicle, the delta could be in the range of 50,000, 60,000 from petrol versus CNG. If you go to commercial vehicles or heavy segment of around 18 tons, 20 tons truck, and the delta could be in the range of 3 lakh, 4 lakh rupees. So in bikes it is different, in three-wheelers it is different. So the payback also depends on the running of the vehicle. If it is a commercial vehicle, the payback could be less than a year. If it is a passenger vehicle, the payback could be as long as 3 years. but definitely it is not in the range of 8 years. And over a period of time, if you see the history back in 10 years also, the CNG and petrol delta has been maintained quite substantially over a period of time, despite fluctuations in both petrol versus CNG prices or oil versus LNG prices. So going forward also, we think substantial delta should be available at least in petrol vehicles. In case of diesel vehicles, the technology is improving, the infrastructure is improving, and we are funding, as Rajesh correctly mentioned, that part of the upfront capex we are funding for diesel commercial vehicles. And also we are promoting retrofit of the diesel or diesel commercial vehicles from diesel to CNG. Because in Mumbai, after 8 years, you can't run a commercial vehicle on diesel in the municipal limits. So they necessarily either have to sell those vehicles or take it as a either you have to sell those vehicles outside Maharashtra, or they have an option to retrofit it. And in case of retrofit, we are funding 50% of that cost. That's a very good incentive for the owner of the truck, because here trucks are sometimes owned by a single person and it's not a very big fleet. So they are very sensitive to the price. And if it gives a delta of around 15 to 20% also over diesel, they will be more than happy to continue with CNG. The other part related to excise cut and GST, this has been under discussion for quite some time. GST again is a GST council subject, and the excise cut was talked about during the budget also. So let us wait. If that happens, it will be very good for the industry.
Sure, sir. Thank you so much for answering my questions, and best wishes for Diwali. Happy Diwali to all of you, sir.
Yes.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. The next question is from the line of Yogesh Patil from Dolat Capital. Please go ahead, sir.
Thanks for taking my question. Sir, as you mentioned, the EBITDA margin guidance of rupees 10 to 12, and we are still waiting for the CNG price hike which is due. So this guidance is considering the CNG price hike or without CNG price hike? That's one.
See, EBITDA margins, right now we have 11 rupees for the half year basis. Now we have still 6 months to go. What we are doing is we are evaluating all the options of getting the gas at the cheapest price. Also, we are taking operational efficiencies, the volume efficiencies are with us. So we will see, but 10 to 12 guideline is still we can maintain. We hope that we will be able to maintain it. But even if it is certain, it has to be taken to maintain the volumes and to maintain the price stability for giving confidence to the customer. We will always be for it. But as of now, we think 10 to 12 is the margins after considering this allocation cut.
Sir, quickly reframe my question. Suppose we do not pass on the gas cost to the consumer, what kind of a hit will come to our gross margins level overall basis because of this reduction in APM gas allocation? Any ballpark number if you have?
See, the point is industrial and commercial any which way are going from LNG contracts which we do have. The PNG is getting 100% allocation. The main effect on the deallocation is on CNG segment. As we said earlier, we are trying to figure out that how the cost gas can be procured at different sources. We are also going for procurement tenders. The rate discovered will determine about how we can, how much we can retain with ourselves and how much we have to pass on. And what is the volume growth we want to see, what is the EBITDA margins which is in the comfortable range. It is not a very strict range that 10 to 12 is some sacrosanct number. It is just a guidance. It can go up or it can go down also, depending on the cost of procurement of gas, because we will be floating the tenders. There will be gas which will be coming on HPHT. There is gas which is on new well gas, which further will be enhanced on the exchange. Then there is IGX, then there is Brent link contracts, there are Henry Hub link contracts, then the spot is available. So all these things are very dynamic in nature. So as I said that we are still comfortable with 10 to 12 rupees, but it can vary slightly up or down as few months go by and we get more clarity on what the procurement cost is.
So, sir, during the quarter, how many CNG vehicles are added? And if possible, please provide a breakup of vehicle additions in terms of a taxi, three-wheeler, and personal car. And if you have any updates on the two-wheeler additions, that would be helpful.
In the quarter, we have added 23,000 vehicles, around 15,000 are private cars, 6,000 are three-wheelers, and rest are other all put together, small commercial vehicle and few MSRTC buses are there, taxis are there. Two-wheelers, around 1,200 two-wheelers have been added this quarter, which has Bajaj has launched. So if we see the whole year, last year we have added 77,000 vehicles, and now this half year itself we have touched around 44,000 vehicles. So we have seen a traction, but more than the absolute numbers, what is more critical is the commercial vehicles which are getting added. Because each commercial vehicle can take much more CNG volume as compared to say three-wheeler addition. So, we are very hopeful, and the two-wheelers are again a new segment which has opened up for CNG, and two-wheeler running cost is almost 40% of a petrol two-wheeler. So this we find is a segment which is going to attract some volumes going forward, maybe 2-3 years down the line. Anything, Rajesh, you want to add?
No, this volume addition we have been seeing has been maintaining momentum, and with the relaunch of our incentives for commercial goods vehicles in this month, October, we are hopeful of seeing the momentum continue.
So lastly, capex during the quarter and planned capex for FY25-26.
Half year capex has been little more than 400 crore, and we maintain our capex in the range of 800 to 900 crore, depending on availability of pipeline laying permissions, availability of plots for setting up CNG stations, etc. So we are confident that we will do around 800 crore. If things move positive, will be more than that also. As far as budget is concerned, we are geared up to do around 1,000 crore.
Thanks a lot, sir, and wish you happy Deepavali.
Thank you. Same to you.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. The next question is from the line of Nirmal Gore from Aditya Birla AMC. Please go ahead, sir.
Hi, thanks for the opportunity. My question is about the APM gas reallocation. Just wanted to know why there was a sudden reallocation done, because considering the fact that the allocation towards CGD was anyway declining, but the sudden decline of 20%, just wanted to know why this was done, what was the rationale, and in addition to that, if you could throw some light on where this APM gas has been diverted.
I think we are not the right agency to answer this question in particular, because the government at a macro level looks at all these aspects about where to allocate the gas at what price. So pricing and allocation is a prerogative of the ministry. So we don't want to comment much on it, and we don't have privy to what the information about where it has been allocated and why it has been allocated to any segment.
Okay, sir. Thanks so much.
Thank you.
Thank you, sir. The next question is from the line of Hemang Khanna from Nomura. Please go ahead, sir.
Hi, sir. Thank you for taking my question. So again, just going back to the APM allocation, wanted to get a sense on the raw material side. Following the cut and with the sourcing efficiencies you're currently employing, what is your current increase in raw material prices or gas sourcing currently? And a follow-up to that is that, do you, what is the view that, do you believe that you'll be allowed to fully pass on the impact of the higher input cost to consumers? We appreciate that, you're the lowest cost CNG provider in the country right now, but even in that landscape, will you be allowed to fully pass on this impact to consumers?
There are two parts of it. One that you mentioned about what is the cost impact or procurement cost impact. So that we are still working out. As I mentioned earlier also, we will be going to float some inquiries, get the rates from the market about Brent, HPHT gas, new well gas, spot, IGX. So that portfolio will be determined depending on the bids we receive maybe next month or so. And then we will take a call on what will be the procurement cost. Coming to your question on the ability to pass on, I think that question is very well understood by the market, that it's a independent decision of the board of the company or the delegated powers of the board of the company to decide on pricing, depending on the alternate fuel price, cost of procurement, operational cost, our volumes, and the margins which we want to have, and overall strategies of the company. So I don't think we are under any compulsion to pass on or not to pass on. It is a pure business decision taken by each individual company. Also depends on what the other CGD entities are doing, what is the price in the adjacent geographical areas, what are the volumes. All those things are taken into consideration before taking a call on price hike or price reduction.
Got it, sir. Got it. Thanks. And just as a second question, what are the current volumes which are currently in the network?
It's around 4.05 MMSCMD for the whole quarter Q2, and on year-on-year basis, it is 3.95 for the whole half-year basis, as compared to 3.6 for the financial year, full financial year 23-24, and 3.5 for H1 of the last financial year. So we have seen a growth of around 13% on Q2 of last financial year versus Q2 of this. So you see the amount of effort we are putting to make the volume grow, and that is one of the main reasons that we decide on when to price or pass on the price or not to pass on the price, because the customer has to be given a very comfort that their interests are protected. A person who takes a decision to purchase a CNG vehicle or a diesel vehicle or a petrol vehicle is very critical for the company, because then he is hooked up for 15 years with the fuel. So therefore, those decisions are taken as a business decision by the company. Like, well, we have launched this CNG 2 Mahotsav scheme, which almost subsidize or pass on the 50% cost is taken by the company to make sure that the more volumes are attracted.
Got it, sir. No, definitely. Your volume trajectory in the past few quarters has been exceptional, and that's clearly visible. Just as a last bookkeeping question, could you just help with the EBITDA for UEPL? I missed that.
EBITDA for UEPL. Yeah, can you just check it? Give us 1 minute. For SCM, yeah. Around 10 rupees per SCM EBITDA.
Got it, sir. Thank you so much, and wishing everyone a very happy Diwali. Thank you.
Thank you. Thank you.
Thank you, sir. The next question is from the line of Karthik from CLSA. Please go ahead, sir.
Hello, sir. Thank you for taking the question. I had one question on what do you think is the current discount versus diesel in percentage terms? And based on your experience, what is the level of discount that you think customers are fine so that, your volumes are not impacted?
Currently, the discount level is at about 16 or 17% to diesel. And we have empirically in the past, we have seen that, as long as the discount levels are in 15 to 25% kind of a range, the traction continues and we get a continuous stream of new vehicles, new CNG vehicles and conversions. So while we are at a lower discount level, but it's still in a doable range, and again, the discount to diesel is relevant in commercial vehicles where the competition is diesel. For the private car and for the auto rickshaw or two-wheelers, etc., the competition is petrol, where there is a very large incentive anyway for the customers. To offset this relatively low discount and to promote heavy commercial vehicles, we have restarted this incentive scheme. But if you look at the sale number of our small or light commercial vehicles, that remains at 1,000 plus. And that has not got impacted by, lowering of a discount from, I think, 1 or 2 quarters back, it would have been about 19%. Now it is down to 16%. But we haven't seen any decrease in adoption because of that.
And the petrol discount to petrol is around 45 to 50% range, maybe 47, 48%. So there is a substantial delta for attracting petrol vehicles. Now, just keep in mind there are several other things which are happening when a person decides to take CNG or petrol or any other vehicle, is that a lot of infrastructure is getting added up. Typically, we have been adding around 25 stations every year. This year, combined with UEPL, we expect to add 85 to 90 stations this year itself. So OE's models are available and there is a lot of choice. Even original equipment manufacturing like Tatas and others, Marutis, are very aggressive about promoting CNG vehicles. They are redesigning their vehicles. More and more CNG stations are added up by other CGD companies also. So the whole highway is getting created. What I want to say is that the whole ecosystem over the last 3 decades for CNG vehicles have been created. So we want to make sure that this ecosystem is maintained properly for next few years at least. Make sure that the volume growth is maintained and proper delta can be arranged or tweaked to make sure that the volume growth happens.
Got it, sir. And just to follow up, do you think customers care more about the running cost or the overall cost, like the upfront cost that they have to bear in this case?
There are
so CNG versus petrol.
We just discussed some time back. There are 2 types of users. One, that private car owners, if they purchase a vehicle, they see 2 things. One, that convenience to fill CNG, and second, how much they run, what is the operational efficiency. Typically, private cars don't run too much, so their payback is high. For commercial vehicles, if the CNG is available, they have to be competitive in the market. That type of pressure is not there in private vehicles. So for remaining competitive, they will always go for a cheaper running fuel. They typically take account the total cost of ownership, and running kilometers is very important for a commercial vehicle. And therefore, the delta also is not very significant, because if you see the life of the vehicle for 15 years, 20 years, then this original, the upfront capex can be quickly payback in 1.5 years or less than a year for a commercial vehicle. So the decision point is what is the delta between diesel and CNG or petrol and CNG for a commercial vehicle.
Thank you, sir. Thank you so much for that.
Thank you, sir. The next question is from the line of Saurabh Handa from Citigroup. Please go ahead, sir.
Thank you for the opportunity. So my first question is just on this APM allocation cut. Now, the perception is that the CGD sector has been singled out in bearing the brunt of this whole reallocation to, say, ONGC petrochemical plant. Now, in your discussions with the government and the ministry, do you get a sense that there is indeed a shift in their stance towards the priority for the sector, or this is just something which needed to happen and it's a sort of one-off? And if it was a one-off, then why not do a pro rata cut across sectors? Why just the CGD sector?
I think again this was asked some time back. This is a government prerogative at a macro level, that what type of allocation and what pricing they give. If you see, it is not one single point which you can single out and take as a general consensus about it. You have to look at last 15 years or so. The CGD sector has been promoted over a period of time. The first priority has also been given to CGD. The HPHT gas allocation was given to CGD. The APM prices were readjusted once we found that LNG prices have gone over the roof in terms of war and corona times. So it's not that one decision can be taken as a general guidance for what the priorities have shifted or not. Anyways, we are not the party to decide those things, and we don't think that those are the things which we can take as a general guiding for the future also, because the first priority to CGD is still there as far as the government guidance is concerned.
Okay, so fair enough. So my second question is on the recent exclusivity, whatever end of exclusivity notices that have been sent by the PNGRB. Now in that, I think all three GAs of yours are covered. So what could you talk us through if there are any implications of this, or could this again be subject to legal challenges, etc.?
I think if you have seen the notice, public notice which PNGRB has taken out maybe yesterday, there are 73 geographical areas which have been called for the consultation. And if you have gone through that notice, it says that the matter is sub judice, and the court has asked, they have given the freedom to PNGRB to go for consultation. But if any action is to be taken, that needs to be checked through the court in case it is having any adverse impact on the CGD. So it is the prerogative of the regulator to move ahead with the procedure any which way the regulation allows for going for exclusivity. So as has been discussed earlier also, exclusivity is a beneficial thing for all the sector also. We are not against it. Only as a matter of fact, the matter is sub judice, because if exclusivity is ending, there is a opportunity for us to go to other geographical areas to work upon. So we have a market to work with, and since our GAs will be covered, so we will be getting paid for the infrastructure cost plus certain returns on it. So it's not a thing which we are very much afraid of as such. But anyway, the matter is sub judice, so we don't want to comment on that. What PNGRB is doing is very well within their rights, and they are doing for the growth of the sector. We are very much for it.
All right, sir. Thank you so much.
Thank you, sir. The next question is from the line of Madhur Rathi from Counter Cyclical Investment. Please go ahead, sir.
So thank you for the opportunity. Sir, just wanted to understand your perspective on the previous question. So do we see the Indian CGD ecosystem or the gas pipeline ecosystem going towards a common carrier over the next few years, whereby we would receive some kind of rental or for the our infrastructure utilization by different players? So on that front, some view.
I think if we are talking about main gas grid, it is already on common carrier basis. When we talk about CGD, there are two types of exclusivity under the Act. One is infrastructure exclusivity, which is for a period of 25 years, and there is a provision in the Act to go for 10 years extension after the expiry of 25 years. So across the globe also we have seen that the infrastructure exclusivity is maintained in terms of on geographical areas, there cannot be two parties who build the physical infrastructure. Now coming to marketing exclusivity, as discussed earlier also, the matter is sub judice. There is a provision in the Act, in the regulation, not in the Act, that 5 to 8 years time is given for ending of marketing exclusivity, since the matter is under sub judice. So we don't know when it will end. If you say 2 years, 3 years, we can't say it is 2 years, 3 years or prior to it. It's very difficult to give any numbers when the court case will be decided and in which manner or fashion it will be decided. So let us wait for that and see how it rolls out.
Okay, sir. Sir, my next question was, sir, how is APM gas allocation decided between different CGD? Is it based on the number of GAs that a particular CGD has or has the marketing rights to, or how is it decided in the CGD ecosystem?
It is not on number of GAs. It is based on one, that it is done on unbiased manner. Second, it is done on the availability and the demand. And third, it is on the last month consumption. We are consuming 100 units in the last month. Next month, all the demand is aggregated, all the availability is aggregated, and then it is divided. The percentage cut is applied to all the CGD entities, irrespective of or number of GAs.
So basically, like how much volume you can offtake, how much volume your stations can offtake will determine how much APM gas you can bid for. Is that understanding right?
No, it is actual average consumption of the last month.
Okay.
Last quarter, not, sorry, I'm corrected, it is not month, it is the last quarter average consumption is taken as the base figure, that is the demand aggregation of all CGD entities, and the availability projections are then taken, and demand divided by availability, or the other way around, it is taken. Yeah.
Okay. Thank you, sir, and all the best.
Thank you, sir. The next question is from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead, sir.
Thank you, sir, for the opportunity. One question to understand about the sort of our vehicle pool. Would you be able to sort of divide it into two pools where the vehicles use typically 30-40 kilometer of run every day, and the one which have the significantly higher run of 100 kilometer plus? Is it possible to give some approximate number?
I think,
sorry, can you repeat the question?
Are you saying 30-40 kilometers or 80 kilometers? There are different, passenger vehicles run maybe 40 to 50 kilometers in a day, whereas commercial vehicle will run around 200 kilometers a day, or maybe more than that.
And it depends on the class of vehicle. If you take a, let's say, Uber or a Ola, it may run 150 kilometers a day also. A typical MSRTC bus would run about 400 kilometers in a day.
Commercial vehicle?
Commercial goods vehicle, again, it will depend on the class of vehicle. If it's a small light commercial vehicle doing, Bhiwandi warehouses to city 2-3 trips a day, it may be about 80-100 kilometers a day.
And heavy commercial vehicles run maybe 300 kilometers a day.
The highway, the vehicles which run on the highway typically run hundreds of kilometers a day. Private individual vehicles, typically the per capita is a bit lower, because they mainly use it for commuting, etc.
And even three-wheelers run 100 kilometers a day.
Yes, three-wheelers also run about 80-100 kilometers a day.
Is that the question was, or something else?
The way I wanted to understand was how much percentage of our CNG consumption will be coming from the higher usage vehicle, which would be less impacted by, or which would be subjected to sort of the price change in the CNG. Would it be something like a 40-50% of the CNG consumption exposed to that, very sensitive to price change?
No, look, once the vehicle is on CNG, if the vehicle has to run, it will buy CNG. It doesn't have any other choice. So typically, if the discount decreases or CNG price increases, etc., what tends to happen is incremental addition of new vehicles, growth rate starts dipping a bit.
Just to add to what Rajesh said is that diesel vehicles, there is no choice. In petrol vehicles, there is a choice that they can run on petrol or CNG. Like small passenger vehicles, they can run on either petrol or CNG. But for a diesel vehicle, for a heavy truck, if it is converted to CNG, or if it is a OE truck, then it can run only on CNG. They don't have choice to switch back to diesel or petrol. Small commercial vehicles also.
Yeah, I do understand that. But basically, if at all the savings enjoyed by the existing vehicle goes down, typically the addition also goes down because of the sentiment. So how much percentage of the pool would be basically in that category?
A very small number. The commercial vehicles and heavy commercial vehicles and buses, they are, as far as overall numbers are concerned, very small in number. But the typical per capita consumption is high in commercial vehicles.
Look, they would not be contributing more than about 12 to 15% of our overall CNG sales. Big chunk of the CNG sales comes from private cars, taxis, and auto rickshaws.
Right.
State transport undertakings put together would be about 7 or 8% of the overall CNG sales.
Another question was about basically, we understand that short-term allocation of the new well gas has been given up to the 31st March 25. So what is the allocation that we have got for the short term till 31st March? Is it 50% of the APM requirement that we lost?
Not exactly. We will come back to you on this number, but new well gas we have also bidded, and there more gas is expected to come online. So we are waiting for that also. But we did not get the full quota of new well what we quoted for.
Sure. And the last question was about the industrial and commercial. We are seeing a very good growth in this segment. So against sort of the volume that we have agreed, how much percentage is already sort of ramped up to, and what is the balance that can come over the next year or so?
We are expecting low double-digit growth to continue for at least another year or year and a half in the industrial segment.
Industrial and commercial put together, we got 12% high growth last year and maybe 10 to 12% this year. So the sourcing of this volume is already done by us in terms of some contracts of LNG.
And we have signed contracts with new industries for a pretty good volume, which we will be connecting in the coming construction season or the ongoing construction season and next year. So that will contribute to additional volume.
Sure, sir. Thanks for this clarification and wish you all happy Diwali.
Thank you, sir. The next question is from the line of Ramesh from Nirmal Bang Equities. Please go ahead, sir.
Thank you very much and wish you all a very happy Diwali. So, if you were to look at your plan to acquire that 40% stake in International Battery, can you take us through what is in it for you in terms of your long-term business plan in that business? What is the kind of size and the profitability of this company? And can you tie in with some numbers, whichever you can share, in terms of how it would help you generate the return on that investment?
I think it is an opportunity which has come out from the strategy of the company to diversify into, say, non-fossil fuel segment also. We want to have at least, say, 20%, 25% revenue bottom line on non-fossil diversified new areas. So as a matter of fact, we explored several opportunities, and one such opportunity was this, that we are going to set up a new battery manufacturing company, which is a cell manufacturing company. And this will be, one of the first in India, because as per our understanding goes, all cells are getting imported in India through China, Korea, and other places across the globe. What Indian companies are doing is importing the cells and packaging them to make the battery pack. So this will be one of the first company, or maybe one of the few companies to start cell manufacturing in India. The size will be, to start with, we will have 1 gigawatt factory, and it can be scaled up to 5 gigawatt factory in at least 2-3 years time. We will see the performance of first gigawatt. It's a Korean partner, a company, US-based company, which we have joint ventured with, and they have set up a pilot plant in Korea. The product is out and it is being tested in Indian road condition also. The capex size in the first phase will be around 850 crore, and for phase 2 it will be around 3,500 crore. The revenue, once we have 5 gigawatts, will be in the range of around 4,000 CR at the top line, and maybe 700-800 CR at the bottom line. So it's a good segment. Also depends on what is the duty structure which the government gives, because government is promoting a lot of Make in India campaigns, and also since almost 80% batteries are getting imported from China, so we feel that there is a likelihood to put duty on Chinese imports, especially in battery segments, that will further increase the profitability of the venture. So it depends on the product, the type of quality which we produce, the type of chemistry, the acceptability, the rate of production, and so on and so forth. So it's a newer area for us, a new venture for us, and we are very optimistic and excited about this whole opportunity. And if it makes sense, then it can be a good game changer for the company.
So in terms of the timeline, when do you expect to finalize a shareholder agreement and get started on this project? And what is the execution timeline?
It's a non-binding agreement which we have signed, and we expect to close this signing of SHA in few months' time from now.
Okay. So on the LNG retailing business, what is the kind of roadmap you have for, say, 2-3 years? You already talked about adding some stations, and you know that you are doing a certain amount of volume in your Savroli station. So when do you see some kind of critical mass in the LNG retail outlet in terms of number of stations and LNG volumes, and how much do you think it can add to your top line and bottom line, say, in 2 to 3 years?
It's a very nascent stage. Right now, in India, around 17-18 retail outlets are working off LNG. One is Savroli, which we have already commissioned from MGL. And very recently, a few days back, we commissioned another station from Mahanagar LNG, which is a joint venture company of MGL at Aurangabad. Now, next 2 years, there will be several stations which are coming on board from MLPL and from other parties like GAIL, IOC, OMCs, Petronet, and so on and so forth. So what we think that LNG infrastructure is, I mean, the puzzles are solved in terms of regulations, in terms of safety standards, in terms of technology, in terms of OEs coming up, in terms of retail outlets coming up, in terms of giving some discount to diesel. And also, if we have to see the environmental impact, if we have to replace diesel, there are very few alternates available, and one such good alternate is LNG. Because LNG, one fill can take you to 1,000 kilometers run. And if we talk about electric vehicles on long haul or heavy commercial vehicles, it is not feasible considering the very prohibitive capex, the range anxiety, the charging time, and the weight of the battery, and the replacing of the battery in a period of time. Again, hydrogen is 10-15 years down the line. Then you have to have green electricity to produce 60 units to produce 1 kg of hydrogen. Again, burn it or use as a fuel cell to run the hydrogen. Create a whole ecosystem, codes, technology, adaptability, infrastructure. So we think if we have to go for net zero compliances, and almost 3% of commercial vehicle is emitting 35% of carbon CO2 emissions in the transport sector by heavy commercial vehicles to commercial vehicles. That is the segment which LNG is trying. Maybe in 2 years down the line, if we see MGL, we will have good numbers because more and more ecosystem is getting ready. More OEs will be coming, more customers will be ready to reduce their carbon footprint, and we as a company find that LNG will be a good segment to work on. Exact numbers will depend on how many number of stations we put up, how much volume we are able to attract, but it will not be very substantial in the overall scheme of things in terms of revenue and profitability for at least 2-3 years. But down the line, 5-6 years, it can be a substantial number.
Okay. If I can squeeze in one more last question. So when you talked about the growth outlook in the second half, when you said additional 3%, are you talking about a 10% volume growth in the second half? How should we read that?
No. I think, let me make it clear. 7% growth we have achieved from 31st March 24 till 30th September. So if we talk year on year from 31st April 24 till 31st April 25, it will be 10%. So 7 plus 3%.
So for the full year, it is 10%. That's what you're saying.
Yeah, that's right.
Okay. Thank you very much, and wish you the best of seasons and happy Diwali. Thank you very much.
Thank you very much.
Thank you.
Thank you.
Thank you, sir. As there are no further questions, I would now like to hand the conference over to Mr. Probal Sen from ICICI Securities Limited for closing comments.
Thank you, Palak. Thank you very much for all the attendees as well as the management for taking their precious time out and taking an extended time beyond the set time to answer all the questions with as much details as they could. Wishing everybody and their loved ones a very happy Diwali. From the management side, sir, any closing remarks you would want to make? Otherwise, we'll cut the call.
Thank you so much, Prabal, and all the investors who have joined and taken time out to have this conference. Wishing you again and your family a very happy Diwali and a New Year, prosperous New Year. Thank you so much.
Thank you, everyone. You may exit the call now. Thanks.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect.